Welcome, everyone. I hope you're all having a great Tuesday. Thank you so much for joining today's webinar. We'll go ahead and get started, but today we're going to be talking about how to expand your portfolio by investing in private mortgage lending funds. I'm delighted to be joined by real estate expert, Mr. Chuck Cefalu with Ameristar Financial Corporation. So thank you so much, Chuck, for being our featured speaker today.
Thank you, Reneika, for having me today.
Oh, you're certainly welcome. So Chuck is going to give us some valuable insights and practical knowledge on how to help you navigate investing in private mortgages, lending funds specifically. But before I turn it over, I just want to give you a general synopsis or overview of what self-direction is, how it works. And then, of course, if you have questions, go ahead and put those in the question box. We'll get some of those answered periodically as we go. And any remaining questions we'll just kind of hold at the end and make sure that we get all of your questions answered. Again, I'm Reneika Lightbourne with Advanta IRA. I'm one of the business development specialists with Advanta. I've been with Advanta as an employee since 2019, but I'm also an Advanta IRA client prior to joining. So self-direction is something that I personally and professionally advocate. If after today's call, if you want to do a consultation or you have specific questions, you want to talk about your scenario, you're always welcome to give me a call or send me an email. And of course, I always encourage you to visit our website at advantaira.com. It's a great resource for you. Just a little housekeeping before we get started. At Advanta, we don't give any tax, legal, or investment advice. All of the information that's going to be presented today is just more so for educational purposes. So we encourage you, as always, to do your due diligence. You want to consult with your professional team. You want to talk with your attorneys, your CPAs, and financial advisors before making any investment decisions. If this is a new concept for you, I just want to, just give you three key takeaways. First and foremost, know that any IRA or former employer plan qualifies to be self-directed. Obviously, with self-direction, you're always in control. You get to decide what is it that you want to invest in. Today, specifically, we're talking about private mortgage lending funds. And then, of course, third, just know that any income that's generated from that investment flows back into the retirement account. If there's related expenses, it's paid by the IRA. Just a little history about Advanta and who we are. We've been in business for 21 plus years now as the leading self-directed IRA administrator in the industry. Our headquarters is located in Clearwater, Florida. Advanta has an office in Atlanta, which is where I'm based, but we do work with clients nationwide as we have a little over $3 billion under administration. While we don't give our clients any tax, legal, or investment advice, our team is comprised of attorneys and also certified IRA service professionals, which is a designation specific to our industry. One of the things that we do, which includes providing you free educational content that have practitioners and experts like Chuck come in and knowledge share with you. We also make sure that all of our clients have an assigned and dedicated account manager to where we provide you that concierge style service, meaning you have a direct point of contact, you know exactly who to reach out to if you have questions or need assistance with making an investment inside of your retirement account. This webinar is recorded. It will be uploaded onto our YouTube channel and also our video library later today. But you're always welcome to, again, check out our website, our events page specifically. We have a lot of free educational content. We always have, networking opportunities for you. I would encourage you to also check out our blog and also our podcast, which is hosted by my colleague, Alex Perney. So just really quickly, I want to kind of talk through what is a self-directed IRA. Very simply, it just means that you, as the account owner, you're going to have complete control over your retirement funds. You're going to have control over the investment decision, and it also gives you the opportunity to diversify outside of the traditional stocks and bonds. A lot of our clients use their IRA funds to invest specifically in real estate, and then we're going to be talking about, private mortgages, which the underlying asset is real estate. But you can certainly use IRA funds to invest in precious metals, oil and gas, private lending. It's near limitless in terms of what's on the table for you to invest in. So why do people choose to self-direct? There's many different reasons as to why you may choose to self-direct. I'll just touch on three of them. One, it's a new source of capital for you. So if you're looking to make an investment instead of taking out a personal loan or tapping into your emergency fund, or if you're looking to raise capital, this is certainly an avenue for you to do that. Another reason as to why someone may choose to self-direct is because of the stock market, the ups and downs, the volatility. We know real estate is a tangible asset. It's always going to retain value. So for you as a passive investor, you want to be able to have the best of where you have the security of, tangible asset of real estate, but also just more so being a passive investor. And then, of course, the tax benefits, having those rents, those profits, those dividends flow back into your retirement account, tax-free or tax-deferred. In terms of the types of accounts that can be self-directed, it's the accounts that you're already familiar with. So for individuals, pre-tax accounts are traditional IRAs, meaning you get the tax break up front, you grow your account over time. Once you reach retirement age, you take those funds out. That's when you're responsible for paying taxes. Whereas with a Roth IRA, you elect to pay the taxes up front. You grow that account over time. As long as you've held that Roth account for 5 years and you're 59 and a half, which is the IRS retirement age, those distributions will be tax-free. If you are an entrepreneur, business owner, or you have a side business, you can certainly look to self-direct a SEP, simple, or solo 401k. Solo 401ks are very attractive specifically for our real estate professionals or real estate investors, where you have higher contribution limits, greater flexibility. Again, if you want to know more, kind of talk through which opportunity, which account type works best for you, you're always welcome to give us a call. Some lesser known accounts that are still as important in terms of self-direction or give you the ability to self-direct includes educational savings accounts. So you can cover education expenses for your kids, your grandkids, nieces and nephews. With an HSA, as long as you have a high deductible medical plan, you're able to self-direct, or you're able to have an HSA that can ultimately be self-directed. So you do want to check with your plan provider to ensure that you have the correct type of high deductible plan. And then any former employer plan, whether it's an old 401k, a 403b, or TSP type plan, can be self-directed. The only thing that you need to be mindful of is if it's a current employer plan and you're not yet 59 and a half, then most times there will be a restriction in terms of not being able to move it. You can certainly ask to see if they'll make an exception. If it's in a former employer plan, though, there's no restriction. You can move those funds over. In terms of funding your account, you have several ways you can fund your account. If you have an existing IRA, so let's just say you have an IRA at a brokerage firm like a Vanguard, Fidelity, Charles Schwab, you can move as much or as little as you want to or need to make that investment. At Advanta, we'll guide you through that process, meaning fill out our paperwork and we'll actually submit that request over to the other IRA custodian on your behalf. You just need to ensure that whatever amount that you decide to move is in a cash position. If it's an old employer plan, like an old 401k or TSP type plan, you would actually have to initiate that request. Again, we'll guide you through that process in terms of what to tell the plan administrator, letting them know that you're moving funds from one retirement account over to another qualified retirement account. You're not taking a personal distribution. We'll provide you with the address of where the funds should be sent in terms of how the check should be titled, and then the address to send it to. So it's transferring from an existing IRA or moving over from an old employer plan. And then the other way you can fund your account is by making an annual cash contribution. As long as you have earned income, the IRS allows you to make contributions to, for example, for traditional and Roth IRAs. If you're under the age of 50, you can put in up to $7,000. If you're over the age of 50, you have an additional $1,000, so up to $8,000 in a traditional or Roth IRA. For SEP IRAs, you can contribute up to 25% of your earned income, so not to exceed $69,000. Same thing with the solo 401k. You have the ability to contribute, if you're under the age of 50, up to $69,000. So essentially, you get to contribute as an employee, but also match as an employer, which gives you that high contribution limits. For ESA accounts, you have $2,000 per year per child. With an HSA for 2024, for individual plans, you can contribute $4,150, $8,300 for a family plan. But also, if you're over the age of 55, specifically for HSA, you have an additional $1,000 that you can contribute into your HSA plan. When you're ready to get started, the process with us is actually pretty streamlined. It's pretty straightforward. You can actually just go to our website and click on Open a New Account. It'll guide you through the ability to complete our IRA application online. Once you've completed the application, we get your account open typically within 24 business hours. We'll also assign you a dedicated account manager that's with you for the life of your account with us. So that's step one. Step two is funding your account. You can use a combination of all three in terms of making an annual cash contribution. As long as you have earned income, you can transfer as much or as little as you need to from an existing IRA, or you can also move funds from an old employer plan, like a 401k, 403b, TSP, 457, or so forth. And then finally, step three, start investing. What is it that you're interested in? Whether it's investing in oil and gas, or investing specifically in private mortgage lending funds, something that Chuck might say on the call that may be of interest to you, or doing a fix and flip or a rental property in your IRA. And with that, I'll go ahead and turn it over to Chuck so he can kind of knowledge share more about himself and Ameristar Capital Income Fund. Just bear with me one moment. Let me make Chuck the presenter.
Welcome, everyone. I was going to say good morning, but it's actually afternoon here in upstate New York. We got about a little over 45 minutes left, so we'll try and make this as informational and educational as possible. If you have some questions, please put your questions in. If there aren't too many, I'll take them as I present, but if we see there are a lot of questions, your question may be answered through one of our slides, and we'll hold them to the end. Just a little background on myself before I get started. I've been investing in private mortgages for the past 34 years, and I've been involved with buying, selling, and originating private mortgages on a national basis. Those same private mortgages we have sold to insurance companies, REITs, banks, consumer finance companies, private investors. We have also sold many private mortgages to various self-directed IRAs and custodians. And also we work with a lot of doctor groups and medical professionals. My background, I'm actually a licensed real estate broker for the past 19 years, a certified real estate instructor, and I was a former financial advisor with Merrill Lynch. So very well versed in obviously traditional investments, also as well as alternative investments, and that's what we would consider a private mortgage. Over the course of the 34 years, I've also been involved with development, construction, renovation of real estate, and real estate sales. Why do I tell you that? Is that private mortgages can be a wonderful investment instrument for you, but you do need to do some due diligence. And those credentials and that experience allows me to do what I feel is the necessary due diligence on these before we actually originate or purchase a private mortgage. So with that said, I have worked with many investors that have significantly amassed wealth investing with their self-directed IRA and have used private mortgages, ongoing as building their wealth. So we're going to talk about a private mortgage fund today. And what I would say to you is that prior to establishing this fund, we obviously dealt with investors on a one-on-one basis and would sell the private mortgage to the investors. And we did that for quite a long period of time, and we still do that. So that is an option if somebody says, I just want to buy an individual private mortgage. That obviously is available. But what I did find out is, not everybody knew how to do the necessary due diligence, or once they originated a private mortgage, how to service that particular private mortgage. And as in anything, you can have something that is performing very nicely and something that you didn't do or maybe didn't know what to do in servicing that loan and now presents a problem. And here's what I mean by that. Towards the end of 2023, we had been working on this fund for a couple of years during the pandemic, and just kind of waiting for the right time. Again, of selling loans directly to investors, and I had one in particular that he just kind of likes to micromanage his investments. And behind the scenes, I still kept an eye on this stuff, but he was adamant that he had to service his loans. We have our own servicing company where the loans are professionally managed and serviced, but I still was keeping an eye open on one of his investments. and he went on vacation for 3 weeks. And what he didn't know, well, he kind of forgot, was that the borrower had not paid some taxes on he had a large accrual of taxes, and if the taxes weren't paid by a certain date, potentially could jeopardize the position of his mortgage with a tax foreclosure. So while he was gone in 3 weeks, I knew it. I wrote the check. So when he came back, I kind of said, hey, you kind of forgot something here. And I told him. He's like, oh, geez, thank you so much. And he finally says, I'm done servicing these private mortgages. You handle it, and you do it professionally. So that was really a big motivation, where some of my investors wanted to be able to still invest in private mortgages, but have it professionally handled and managed. And obviously the Ameristar Capital Income Fund was born. So let me just say, before we get started, I'll give you just a quick disclaimer. Obviously, this is for discussion purposes. Any investments that you do make carry some risk. You should always do your due diligence. You should always consult with the professionals, whether it's an attorney, CPA, financial advisor, to get their input and have them look at what you're doing. There are no guarantees in any investments that are made. And today is just telling you a little bit about private mortgage funds. And obviously, as Reneika had said, Advanta IRA doesn't approve, disapprove, endorse, or recommend any type of investments. And that will be the disclosure for today. Okay. Brief outline, which we're going to touch upon here. So let's talk about, we have Ameristar Financial Corporation is really our holding company that originates these private mortgages and then assigns them into a fund. We professionally underwrite these loans and then obviously service those loans until they obviously pay off. It's great. Obviously, alternative investment. We work with investors, contractors, developers, business owners, a lot of real estate professionals that create repeat business. Some of you may know it as hard money lending. If you're curious about where that term came from, it came from the Great Depression, when banks were no longer lending, and there were private individuals that, obviously people weren't working, or they were out of work, they're unemployed, they weren't generating income, but they might have had a home, and the private lender would lend money based on a hard asset or that home, and it certainly wasn't based on credit or income, their employment, and all of that. So, we're different than a traditional lender. A traditional lender is more of a credit-based lender that is looking at your income and your ability to pay, whereas private mortgages, it's more of an equity-based lending situation, and we're really focusing on what's your exit strategy for that particular property. And you're seeing more and more, private lenders taking more, how should I say it? There's more private lenders out there now that are really filling a void where a lot of traditional lenders are tightening up with their criteria. And we still need to get real estate financed, and that's where we all come in. In particular to our fund, I'll just touch upon a few things. When you create a fund, essentially you're pooling all these private mortgages into a basket. Let's consider it a basket of private mortgages. You're no longer investing in a particular mortgage, or someone's investment is spread over all of those mortgages. For the purpose of this fund that we came out with, it's a $75 million fund. It has a $50,000 minimum investment. What's nice about funds is, a lot of times you'll have a certain amount of money in your self-directed IRA, and it may not be enough to fund a private mortgage. If somebody comes to you and says, hey, I need a $200,000 private mortgage, and you only have $50,000 in your IRA account, you're like, I really can't participate in that. So the investment to get involved with the fund is typically lower, and then you can reinvest monies in any increment. So there are a lot of IRA holders that are sitting on a lot of cash but they're just shy of some of the mortgages that are being presented to them. In the meantime, that cash that's sitting in your IRA is not earning anything, or very little, and this is a way to obviously deploy that cash. What's nice with a fund, unlike an individual mortgage, there's a preferred return that is typically paid. In this instance, there's a monthly return. So on a specific day, you're going to get an electronic payment made right into your IRA account. And then there's obviously some additional yield in the portfolio over time that is accumulating, and they share that. And this is a typical structure, an 80-20 structure, where 80% of the net income is then shared with all the members and investors. It goes back to them with an additional quarterly distribution. Should be known, most of these funds are Reg D 506C filings with the Securities and Exchange Commission. This particular fund is all filed through Edgar and various state attorney generals, where you can invest in all 50 states within this fund. But it is only open to accredited investors, and that is very, very important to underline. Most of the funds out there are for accredited investors, and if you're not familiar with what an accredited investor is, there's really the two main criteria. It really comes down to an individual that earns $200,000 in the past 2 years, or jointly with their spouse $300,000 in the past 2 years. That's one of the criteria. And then the other catch-all criteria is somebody that has $1 million in net worth, excluding their personal residence. There are other non-income or asset qualifications. If somebody was in the securities industry and had a securities license, they're considered accredited. Or if you had an entity that had over $5 million in assets. For those that are non-accredited, most of obviously in the 506C filings and offerings, you're not going to be able to participate in them. If you're still interested in private mortgages and investing with your IRA, we certainly have a mechanism where you can purchase individual mortgages and put them in your IRA. You're just not going to recognize some of the advantages of the particular fund. So obviously the objective with a private mortgage fund, the first thing is to preserve principal and generate current income. These funds are really income generators. They're not meant to, like a real estate fund where there's depreciation, there's appreciation, and there's some other benefits with respect to actually investing in real estate. This is completely an income play. They're looking for a stable current income with some consistent returns, obviously within a tax advantage structure within your IRA. There's certain underwriting that we do on every loan. I mean, we have access as a professional to tools such as credit reports, broker price opinions, sales comps, tax data. We have a Rolodex of professionals, attorneys, title companies, escrow companies, field agents, inspectors, other real estate agents. So, and we obviously have these funds and obviously the people that work within our organization have knowledge of the state laws and the mortgage laws. So we have resources because we do this as a business and professionally every day. That's not to say the layman can, they can perform their own due diligence and they can determine whether, yes, I feel comfortable in doing this private mortgage. What I can say to you is I've just seen a lot of people now. There's a lot of money out there in the marketplace floating out, and everybody is looking to do a transaction. And I would tell people to kind of pause for a minute. There's just a lot of dollars chasing deals because I see people doing deals that don't make sense. And it all, once their money's out there and invested, and if that particular asset doesn't perform the way it does or should, or you'd like it to, you can look back at some of the things that you may not have looked at and said, I should have examined that a little more closely, and maybe I wouldn't have done that. So I can't underscore enough doing your due diligence on these. Couple things while I'm on this slide that I think is crucial that everyone, when you're investing in the fund. Know that we do all these things, but you should also do this as an individual and be mindful of these if you hold these private mortgages in your IRA individually. Title insurance. We're always going to have title insurance on every loan that's in our fund, as you should have title insurance on every loan that you originate. And that's to protect your position and to make sure that you hold a valid mortgage on that property, that this is your collateral, that there aren't other liens or encumbrances that could jeopardize your position. Very important. Homeowners insurance. We see a lot of people that are lax in that neighborhood. They're not looking at when the homeowner's insurance cancels or renews. They kind of looked at, they got a binder at closing, and then they just kind of forget about it. We as a professional with our fund, when we originate a loan, we make sure there's a 1-year paid in full insurance policy. All this data is inputted into a servicing platform, and we're monitoring that at all times. Because if something goes past a year, if you have a mortgage that's longer duration, you're going to now have to make sure you get updated insurance. Fires do happen, and there are, properties that burn to the ground. And if you don't have the insurance, you obviously could potentially be risking your investment. Property taxes. We're always monitoring the property taxes on a property. Most private mortgages that are originated, whether it's in a fund or yourself individually, you're not escrowing for taxes. So you're relying upon the borrower to, pay those. And a lot of times they're not. They're accruing, and then they build up to a huge amount. And the next thing you know, you have to protect your position, have to go, write a check for $20,000 or $25,000, a check that you may not have at that point, or risk your investment. We've been doing this for quite a long period of time, but there are some times that you have to perform some collection efforts. Sometimes individuals don't know what that's involved to, collect and make sure that they get prompt payment. If somebody was to default on a private mortgage, there's a default mechanism. What do you do to, protect your interest or potentially have to foreclose? When you're in a fund and you have professionals that this is what they're doing, we have people on staff that are sitting there making sure that payer is paying promptly. The payment isn't made. There's, obviously a course of action, series of letters. We're calling them. We're communicating with these borrowers. Doc prep is a big thing. If you're looking to lend in various different states, you obviously have to understand the mortgage laws that impact you, and the documentation, is different from state to state. We deal with counsel that we can originate loans, and it's about 54 states that we can originate in right now. And, you've got to know that documentation is there to protect you and that there aren't any issues. Obviously, many times people are not fully aware or versed with that. So those are some of the things with the fund and the advantages that come to the table for you.
Hey, Chuck, I have a couple questions, related questions, if I can interject really quick.
Sure, absolutely.
So question is, what do you charge to service private mortgages? Another related question is, what are the fees associated with investing in the fund? Do you have management fees, performance fees, so forth?
Okay. Typically on the servicing side, we charge 50 basis points, which is a half a point of the unpaid principal balance. So as an example, let's say we originate a $100,000 mortgage, and then we assign it to somebody in their IRA. We then professionally manage that asset until it pays off. And it's 50 basis points, an annual fee of 50 basis points. Obviously, divide that monthly, and then we remit the difference into the IRA holder's account. That's as it relates to the servicing of a private mortgage. As it relates to our fund, and this is a typical structure of the funds that you'll see. Our fund pays out a preference of 10%. So 10% on an annual basis, they're getting a monthly check or ACH on the 10th of every single month, representing a 10% return on their money. Quarterly, our loans, we have prepayment penalties, and we're writing, obviously, mortgages at different interest rates. We have a third-party administrator called Opus Fund Services. They're like they've won numerous awards as a fund administrator between $250 and $1 billion. They've won a lot of industry rewards. They're top-notch fund administrator. But they figure out the net income being generated in this particular fund. As a fund manager, there's a fee associated with that. There's 50 basis points to manage those assets, and then there's a 1.5% fee to the manager. Outside of those fees, there's an 80-20 split in terms of the income distribution in the fund, where our projected target annual return is 13%. So just figure you're getting a 10% return payable monthly, and then you're going to get 4 distributions, which collectively should be about another 3%. So that's what we're on track for in our projections and what we see within our portfolio. And that's obviously an attractive double-digit return.
Wonderful. Another question before we go to the next slide is, how has the loan repayment been thus far? What percentage have been bad loans?
We've had a very, very low percentage of delinquency. But let me qualify what I mean by delinquency. We've had some people that they get involved in a project. We do fix and flip loans. We do bridge loans. We do long-term, what they call DSCR loans, 30-year mortgages. Just from an interest rate risk standpoint, we don't hold those long-term. Those are placed with institutional investors. So for the sake of what we do, consider it fix and flip and bridge. I'm pleased to say that we have had very few foreclosures, an actual foreclosure. We have right now 2 small foreclosures, and this is after you're dealing with thousands of mortgages. Typically, we have such a close relationship with people. If something isn't working out, we try and give them some resources. Let's say they're renovating a property. We have some project managers and involved with renovation to kind of help them get past that. And there are times we do a deed in lieu. We feel that given our relationship with our borrowers, that a foreclosure is the last thing you want to do. That's time, that's money. The loan is in non-accrual status. You may have to now pay for force-placed insurance or taxes or something like that. I'm happy to say in our fund, we do not have any foreclosures, and all of our mortgages are performing wonderfully. I deal with a lot of medical professionals and doctors and chiropractors, and they're busy doing their profession. So the last thing they want to do is deal with is having to worry about collection efforts. And, knock on wood, none of them have had a loss in their principal as a result of investing in those mortgages. We just have a really nice, clean portfolio. Others that I hear, I've heard, 0.5%, 1%, 1.5%. A lot of the fix and flip, the reason why you see fix and flip mortgages with such low delinquencies is because the exit strategy, they're not holding onto that asset for a long term. Their job is to buy the property, fix it up, and then obviously they're going to sell it retail to, put it on the market, for a family. And we're very, we're looking at after repaired values and looking at the sales and making sure that, we're in a conservative loan to value on that property when it sells. And even if the market made a little adjustment, there's still plenty of equity in there. So, very low. And like I said, we have 2 small foreclosures, and that's overall we don't have any in the fund at all, 0. This is outside of that. And, like I said, if we have a default, we typically will sit with the borrower and work something out with them. And there have been instances, I'll tell you this, there's instances where we see there's a bunch of equity and you don't want to be tied up with a foreclosure and that whole legal process. I've had people, if I say, hey, listen, you're in over your head, and you've tried to do what you need to do, I write them a check. And we take the property back, because what you have to know with Ameristar Financial Corporation is we have some ancillary companies. We have a real estate firm. We have a property management firm. We have a renovation company that we can send people in to obviously maximize the after repair value of that property and then resell it. So we have a mechanism there that a lot of people don't have, and they don't really have that ability. I hope that answered your question completely.
Wonderful. Thank you, Chuck.
Any other questions in there?
Actually, there is other questions. I can ask them, or you can kind of go through a couple slides. But
I'll go through a couple slides and then just jump in there. And I would say this is self-directed IRA customers, clients. I attend a lot of real estate investor associations, RIAs. They're nationwide. They're everywhere. And I would certainly encourage those people that invest in private mortgages or real estate to attend those real estate investor associations. And I do, and I give presentations at them on a variety of different topics, not just a fund or private mortgages, renovations and all that. But if you're looking to obviously, find business and to be able to deploy, your self-directed IRA monies, our target market, which is your target market, real estate investors, contractors, real estate professionals, self-employed business owners, developers, builders. We actually lend to land banks that take tax foreclosed properties back, and they're sitting on huge amounts of tax properties that they want to obviously get back on the productive tax rolls. We lend money to land banks. It sounds funny to people when you say that, but we do. And then we do it. There's a large real estate investor network out there called REAM, with about 5,000 women that are pretty active out there on a national basis. So this is the target market. If you want to know where does this business come from, or where could you get this business, certainly you can go to that market there. I like to always put this up here. It's a lending comparison. It's the traditional lending, on the left, our private lending, something on traditional lending, you go to a bank credit union, they're pretty much focused on 1 to 4 family owner occupied homes. You need to be licensed. They're looking at the property condition. They have some very strict regulations and secondary market criteria. They're heavily making decisions based on FICO scores, your debt to income. These are long-term loans, 30-year loans. They're focused on the borrower's ability to service that debt. They're high loan to value, so usually there's an insurance component in PMI to protect the lender in the event of a default. And they're owner-occupied properties, and these properties have to be in good to superior condition. We're not in that market, and you as an IRA account holder shouldn't be in that market because there's a lot of criteria and licensing required to be in that market. We're in the private lending, where we're working with non-owner occupied homes, investment properties, multifamily, light commercial, mixed use, maybe a special use property. We've done some nice projects. We've done school conversions where schools converted to apartments. I recently did a knitting mill that's being converted into senior apartments, and just kind of retro, coming up with a new use for some really significant pieces of assets out there. Most states don't require licensing requirements for hard money lending or private lending. There are about a half a dozen states that do. We obviously stay out of those states. We're more accommodating. We can lend on properties that may need repairs and they may need renovations. You're going to focus on the asset and the equity. We're a little more lenient with respect to credit profiles. We understand life happens, things happen, bad things can happen to good people. But our loans are shorter duration. We're not taking some long-term interest rate risk with 30-year mortgages. We'll do 6-month to 36-month loans. We're talking about going out, maybe 5 years. As it relates to somebody in an IRA, that want something to go out. They don't want to get paid off and then have to go and do another loan. One of the big advantages of a mortgage fund is that once you make an investment in that fund, the fund is now originating loans, and if there's payoffs, they're reinvesting those monies. You're still getting paid based on your initial investment. So your investment is not tied to any particular loan. In fact, you're diversified over all of those loans. So you're not worried about reinvestment risk. You're not worried about prepayment risk, because let's say you hold 3 mortgages in your self-directed IRA and they all get paid off this year, so they paid off. Now your money's sitting there not earning anything. Now you have to go out there and find another asset to lend. I got to put this money to work. And while I may have been earning a double-digit return, be it 12, 13, 14, or whatever percentage in yield you were getting on your money, now it's gone to zero. So now you have some work to now put that money back out to work. With a fund, your money's working at all times for you, and it could be now collateralized by hundreds of mortgages. People like that diversification. They like that their money is not tied to any particular borrower. If there were some late payments, if you hold a mortgage in your IRA and a person doesn't pay that month, there's no interest coming in. If you're in a fund and just say a mortgage doesn't pay, all the other mortgages in that fund are paying, and you're now still getting that distribution into your IRA. So that's kind of very important for people. So I like the diversification and the fact that we can now diversify with different states, geographically, different loans, different property types, different borrowers. When you just have a handful of assets sitting in your IRA, it's more difficult to get that diversification. With Ameristar, we obviously will still look at somebody's credit history. We're still going to look at their income and understand their employment, what their cash reserves are. But these are short-term loans. They're obviously at a lower loan-to-value ratio, and we're always looking at what's the exit strategy. We don't want to originate a loan and say, well, how does this person get out of this higher interest rate loan? How does that happen? Are they going to refi the property? Are they going to sell the property? Very important. We can do closings as quickly as 48 hours, and I can assure you we have done them in 48 hours. We mobilize our team. We do our due diligence. We make sure we dot all the I's and cross all the T's. Our professionals we work with know what we expect, and they do it day in and day out. So we have mortgages closing on a daily basis. If it's a more complex transaction, it may go out another week or two. And if you're doing it in your self-directed IRA, obviously you have to work with the custodian. It may take a couple of days, to get the monies to be transferred out of one's IRA. So, that could change a little bit. Why are people coming to us to borrow from us or to borrow from your IRA? A lot of times these are self-employed people. They don't want to go through the extensive paperwork. They don't want to have to go through the whole qualification process. They may be, writing off all these things. They may have great credit. They may have this, but they don't show a lot of income on their tax return because they've depreciated their stuff or have a lot of write-offs there. The documentation. We have a nice documentation package that I feel protects our company, protects our fund, and obviously anyone who purchases a loan for us. It's been tried and tested, and there's some paperwork out there that I see that's pretty loosey-goosey. The documentation has to be, lender, it leans in protecting the lender. And I tell people, as long as you're performing, you don't have to worry about anything. But our paperwork has some teeth in it to protect the IRA holders, to protect our fund and its members as well.
Okay, Chuck, I have a couple questions that I want to kind of clear through.
Absolutely.
A couple questions from multiple people. It says, what is your LTV? Will you buy my private loans without a discount or a fee?
We have, when we do fix and flip loans, our LTV will go up to 70% of the after repaired value of the home. Obviously, we will fund them, make a disbursement at closing, and then as they progress with improvements and renovations, we'll make subsequent draws till it's fully advanced. But at the end of the day, we want to be underneath 70%. We have many properties that we originate. I mean, we're across the board. We could be 25, 30, 40, 50, 60, 65% LTV. I mean, obviously everybody would like to be as low as possible. I would have to say our fix and flip are our highest exposure at that 70%. When these houses are fully renovated and they go on the market and they sell full retail, and it's a short-term exposure, we're comfortable up to that 70%. The rest of the stuff in our portfolio, we're south of that, 55, 60%. Our fund typically, we're doing direct originations. We have purchased some mortgages in the past, but we're a direct originator of these private mortgages. If somebody had a particular situation that says, hey, would you buy this loan from me? We would take a look at it. We have a lot of experience in buying private mortgages. Years ago, we used to buy a lot of paper at a discount, but that was more long-term paper. But right now, our fund is not out there actively soliciting to buy paper. It's originating the paper, putting it in the fund, and obviously it has investors that are investing in the fund, and the fund is growing to allow us to continue to obviously grow the origination platform.
Okay, and next question is, so if I want to use my self-directed IRA to invest partially in an investment property, does Chuck, your business, conduct non-recourse mortgage loans so we can partner with him to invest in real estate?
That's a great question. That is something that there's a handful of investors out there and lenders and banks that are doing non-recourse lending. Right now, today, we have not done any non-recourse loans to self-directed IRAs. We have looked at it extensively, and we're looking for the right candidate to kind of be a prototype. We plan on doing non-recourse lending and partnering with self-directed IRA owners to help them obviously buy real estate. We haven't done it yet. Obviously, we're going to tweak our documentation. You should know that when you're buying real estate and obtaining financing as a self-directed IRA account holder, you cannot personally guarantee the debt. It has to be non-recourse, meaning that the only avenue that we have in the event of a default is that particular asset. We're not coming back after the rest of the funds that are in your IRA or the beneficiary of the IRA if there was a default or foreclosure. But we are seriously looking at doing that and want to get into that as soon as possible.
Okay, thank you, Chuck. So if you do need a list of non-recourse lenders, again, Advanta, we're not affiliated with anyone, but I can provide you a list of non-recourse lenders nationwide, and you can certainly reach out to them specifically to see what their requirements are as it relates to their terms for doing a non-recourse loan, like Chuck referenced, if your IRA is involved. So there are resources out there if you're looking for something that's immediate today, if it's not available through Chuck. Just bear with me, Chuck, a couple more questions just to make sure we get those answered.
Sure.
It says,
absolutely.
While quarterly true-ups may not be guaranteed, is the 10% monthly yield guaranteed by the fund regardless of any temporary losses and the performances, or do losses get transferred over to the investor and if there are thresholds before the investors see losses impact? Example, some funds managers offer to take first X amount of losses before the investor take losses. I know that's a bit lengthy. It
is lengthy. Here's what I could say is I know that the return that's given off in our portfolio is north of 16%, that we're paying out a preference of 10%. So we feel that we have obviously some adequate insulation in there if there was a default or, the portfolio, let's just say the market went the other way and wasn't performing as we had hoped. We feel that there's enough cushion in there. That 10% is going to continue to be paid. And like I said, with our situation, we have people that buy loans directly, that we have some private investors that are willing to take on a little bit more risk with respect to the size of loan or the type of property or the type of borrower, where they may buy that loan outright and maybe price it accordingly because they feel that that's riskier. When you have a private mortgage fund, we look at things differently. And let me just say this in answering your question. As much as we're originating loans, we're very careful when we put them into the fund. We don't want to have too much weight with any exposure to any one borrower, to a particular type of property, to a particular geographical area. We don't want to have, have all these loans come due at one particular time. And if you get loans that pay off and then you got all this money that you still need to deploy, so we're staggering maturities. So you really put a different hat on. When you become a fund manager, you're just not saying, let me just originate this private mortgage. You're looking at all these other things. You're looking at the performance of the portfolio, the yield of that portfolio, the prepayment speed on the portfolio, what loans are now going to be coming due, what's in the pipeline that you're going to add to it. This is like a recipe, and you're kind of like, trying to make, bake a cake, and you want to have all the ingredients. So you just kind of look at things a little differently when you're managing a fund. And I will say this is, we have a REIT structure. I haven't even mentioned this yet, but our fund has a sub-REIT that for high net worth individuals and ultra high net worth individuals, it provides some other tax benefits to them because of that REIT. But when we have a third party administrator that's generating the reports, the distribution schedules, and you just have another set of eyes on this. We have a REIT specialist that's constantly doing all the necessary testing. There's a lot of belt and suspenders in here. We limit our exposure into any one loan. There's a lot of safeguards that are built into a fund that are not built into when you just originate and look at a particular one mortgage that you may be originating.
Thank you, Chuck. There's a couple more questions. There's a handful of more questions. I know you have more slides, and I want to be respectful of time.
Listen. If it's 1 hour and that's it, that's fine. If it goes a couple
we
minutes
can go over. I just want to make sure I get everybody's questions answered, but also be mindful of the time. It says, just bear with me. Does the fund insist on the first lien upon writing a loan?
We have our loans are first position loans. There have been instances where if somebody's in a project and they needed a little bit more money or something came up unforeseen, especially in a fix and flip, we'll re-underwrite that file and look and say, okay, what's the current comps and the ARV? So we've done some what I'll call supplemental financing, where we've had the first mortgage and we serviced that first mortgage and it's already our borrower where they maybe needed a few extra dollars. In that instance, we will do that. But, generally speaking, all the mortgages we originate are, their first position mortgages, secured by the real estate.
Wonderful. It says, I'm not interested in doing flips initially. I want to create income producing property first because I think this is a better demonstrated for the use of my investment dollars. So I'm trying to learn the path to partner with a hard money lender to buy investment properties for long-term hold.
Well, here's what I would say to you is that I work with a lot of husband and wife teams, and I won't mention any names, but I have a husband and wife that have done 14 transactions with us, and they've generated quite a bit of monies and income as a result of done that. And we we have obviously a comfort level. We've done 14 transactions. We've seen the product that they can produce. We've been there. We can be more responsive to them. We understand their projects, how they renovate them, how the properties sell. We also, and I say this because it just drives the lending. One of our affiliates purchases bank foreclosed properties. It bought over 200 bank foreclosed properties and then wholesales those properties to area investors. And that, will generate some lending opportunities for our fund where we can do some fix and flip loans. Now, we don't do all fix and flip loans. We do, obviously, a bunch of other different types of loans. But the fix and flip, that sector has really been pretty robust out there, a lot of activity. We also deal with a lot of people that are buying a property that do the BRRRR method. They're going to buy a property. They're going to go renovate the property. They're going to go rent the property. They're going to refinance the property, and then they're going to repeat that process. We can help. We work with a lot of real estate investors that are looking to build real estate portfolios. We not only in our fund is the short-term paper. This is, 1 to 3, now going to go to 1 to 5 year paper. Outside of that, we do debt service coverage ratio loans that are loans specific to real estate investors. Those are low interest rate 30-year mortgages. We do those with institutional investors, not in our fund. But those, you don't need tax returns, you don't need financials, you don't need, it's a mini app, and it's based on the income of being generated by the property. So if you're not already, if you're looking to become a lender and put private mortgages in your IRA or invest in a fund that does that, that's obviously one way we could work with you. If somebody says, hey, I need funding, whether through my IRA or outside of that, obviously we do that day in and day out with investors.
Wonderful. Another question before we go through some more slides says, how old is the fund? Can my money be withdrawn at any time after investing? Is the fund looking for a specific target overall amount of money and will be closed upon reaching?
Okay. We launched the fund in the beginning of the year. The fund, we're looking to raise $75 million. It's an evergreen fund, so it essentially does not have a termination. It's not a closed-end fund. If you invest in the fund, your money is essentially, there's a lockup period of 2 years. We don't want to be raising this capital, investing it in the mortgages, and 3 months later, a person says, hey, I need to get my money out. It's like going to a bank and putting the money into a CD and 10 days later saying, hey, I want to take it out. So there is a 2-year lockup period on that. And then after that, the account holder can, they have redemption rights, very similar to like a mutual fund where they can, redeem their investment. If someone, not on this call, but obviously we have a website, that you could go to. You can get more information. We obviously have a private placement memorandum that makes all the necessary disclosures and tells everything that you can imagine in 90 pages. We also have, you're seeing part of this pitch deck that talks about the fund as well. And certainly we're available offline for any other questions as well.
Thank you, Chuck. I know you have some more slides, so feel free to.
I'll touch upon a few of these slides here. Here are some of the property types that we finance that are in our fund. Single family home rentals. You're seeing more and more people renting out, and obviously the rental market and the type of rents that are being charged today are pretty high. So they're holding on to, portfolios of single family rentals. We do that. We obviously do multifamily. We do some mixed-use properties where there may be a storefront and some apartments above. We do not have any exposure in our fund to like retail stores, malls, office buildings. We have zero exposure to that. We selectively could look at some light commercial. Mobile home parks. We don't have any mobile home parks in the portfolio right now, but in the past we've done extensive mobile home park lending and have done very well with that. foreclosures. Like I said, we have an affiliate that bought 200 bank foreclosed homes. They did that, and now they're looking to buy another 200 homes. We obviously do a lot of foreclosures. Distressed properties, we do lipstick and makeup renovations to gut renovations requiring full permits and plans. Any type of renovation projects. I alluded to a mill conversion. I have a knitting mill, big knitting mill, beautiful architectural buildings being converted to senior housing. We do some new construction. Not on this slide is we actually going to be doing some modular homes from an affordable housing standpoint and some subdivisions. We've done some school conversions that have been converted to apartments and or condos. We also do some short-term rentals. That's the hottest thing out there. Airbnb, VRBO. We just recently did what's known as a pad split, which is kind of big in the western part of the United States. That's like the Airbnb of renting out bedrooms. And we help these short-term rentals, and then we'll convert them to some long-term financing after the fact. We talked about our underwriting criteria. This particular slide in this deck is available if somebody wanted this as well. This is in a PDF. I could send this out. But, someone asked about the first position. These are senior mortgages in first position. I talked about the LTV, max of 70% ARV. We're in the 50-60% range on the other stuff. Now, remember, we do business purpose loans. We only lend to LLCs, corporations, partnerships, and trusts. There's a reason for that. There's a lot of rules with respect to interest, usury, and you never want to get involved with a bank regulator trying to decipher, well, was this an investment property or was it a 1 to 4 family owner-occupied home? So that's all we lend to. We always get a personal guarantee from the borrowing entity. We always get an absolute assignment of leases and rents. We're not going to let you enrich yourself, collect all these rents, and not pay on the mortgage. Sometimes we get what an LLC, if we see a borrower, we were hoping they're a little stronger and they're not, we can get an assignment of the LLC interests, their membership interest as additional collateral. You see on the fix and flip, we'll do 12 to 18 months. We can do equity loans 12 to 36 months. You see title insurance, property insurance. Here are some of the collateral valuation methods we do, comparable sales. We look at prior mortgage data, foreclosure data. Sometimes you'll get real estate appraisals, broker price opinions. And we always use experienced private mortgage lending counsel to close every transaction. And in the fund, what we like with a fund situation and our fund structure is, these assets aren't tied to the stock market. Current politics, the real estate trends, the stock market, obviously there's volatility. There's a lot of, economic inflationary things in there, some regulatory and tax risks. We have a very diverse portfolio, different borrowers, different collateral, different loan terms, different, geographical areas. Very important within the fund. I stressed professional management. I can't tell you how important it is to be up on your collections, taxes, insurance, or if there is a default. Whether you service the loan yourself or we service it, that has to always be number one. Underwriting. We use common sense underwriting, but we do have a process to underwrite. Risk mitigation. We have some prepayment penalties. Sometimes we want to have, prepayment penalty, 6-month or 12-month prepayment penalty. We're a little flexible with that with our duration. We do short-term loans. So as we're if interest rates were to spike, we're not tied into long-term paper. In our fund, we say no single loan can exceed 10% of the fund's capital. And I expect us to be much lower than that. That would be rare. We're pretty much what I'll call a small balance sheet lender. Most of our loans are, 250 and under. We do many loans, smallest loans like 50,000. A lot of loans in the 150, 175 range. As soon as you get into larger dollar amounts, there obviously are due diligence and we're going to be looking at this, even further. I mean, no one wants to have some big loan go into default within a fund situation. So, we do have limitations set on that for investors' protection, really. These are some of the projections in our fund. Talks about how on a 16% yield, how it's broken out between interest income, the preferred return, some of the excess return. It's just kind of an exercise that we do. This is available if somebody wanted to take a look at that. You got to remember when you invest in a mortgage fund, these are considered unregistered securities. As much as we're filed with the SEC and various attorney generals, these are meant, for accredited investors, somebody that has a certain amount of sophistication and somebody that, can bear the risk of an investment. So these are not publicly traded. You're not going to go open it up and it's not trading on NASDAQ or, any of the stock exchanges. There are restrictions on the sale, transfer, and disposition of the membership interest. I talked about a 2-year lockup period. If there's an undue hardship, there is a mechanism where you can do an early withdrawal. Could be up to a 5% penalty if that was the case. Really, the fund is going to continue to look to grow. We have a $75 million threshold, but in there it says we reserve the right to raise that threshold because it is an evergreen fund. You'll see there's some withdrawal terms and limits after the 2 years. If people are obviously seeing the returns and the preferred and annual returns, you're not going to see people wanting to get out. Our investors that typically invest in the fund are income-oriented investors. They want to earn income. They want to be passive. They want to know that things are being professionally managed. And that's what the fund, really, that fund structure represents for you. This doesn't really apply to you here. This is if somebody individually bought into the fund where it was held in an individual corporation or their trust. You're already in a tax-advantaged, obviously, IRA account here. So right now, this isn't going to really impact you here. This is here our team. Mr. Harder here, we've worked with him for about 30 years. We have Ryan Bennett out in Iowa. This is obviously our management team here, but we obviously have more employees in terms of processing. We have people that do all the inspections for our draw loans and renovations. We have people out there in the field involved with the renovations and project management. There's a couple salespeople in-house that are not on this particular side. Here's some of the service providers that we work with. There's some of the top providers in the industry, between securities attorneys and fund counsel, closing attorneys, the servicing platform that we use, Opus Fund Service, our administrator. Here's some institutional investors on the right-hand side that we do the 30-year DSCR loans with that are not held within the fund. Certainly if you have any inquiries, my numbers are on the screen there. Office number, that is my cell number that's on the screen. You can take that down. You can email me at the inquiries@ameristarfunds.com. You can also go to ameristarfunds.com, the website. There's a lot of information on that website as well as it relates to our fund. There's a one-page fund summary page that you can click on. And then obviously if you're looking to get a private placement memorandum, you can request that as well.
Wonderful. Thank you so much.
Any other questions we have there before we wrap up? Or?
Yeah, I'll reference. Thank you so much, Chuck. Great information. You have all of his contact information. I also have a copy of the slide deck. So if you would like a copy, definitely you're always welcome to reach out to me and I can email you a copy of it. Also, this is recorded, so it'll be uploaded onto our YouTube channel later today or first thing tomorrow. Just to kind of close out, if you have specific questions relating to self-direction, I'm happy to answer those questions for you. If you want to know more about Chuck and his business, absolutely feel free to reach out to him directly. Just bear with me. One last question before we end. It says, will you lend to owner of assisted living facility as a bridge loan to an SBA loan? I know that's none related to self-direction, but I wanted to at least mention it.
We have lent to it was it assisted living? They were licensed by the state. Yeah, we have been involved in that. You know, again, I tell everybody it's about exit strategy. If somebody comes to us and says, hey, I have this particular property and I'm looking to do financing and I have a takeout lender, but here's what I need to do in order to obviously fulfill all these criteria to be taken out, and here's this interim financing that I need to do that, yes, we would very seriously take a look at that.
Wonderful. Thank you, Chuck. I really appreciate all of the information. Thank you for knowledge sharing with our audience. Thank you, everyone, for attending. Again, if you have questions relating to self-direction, definitely feel free to go to our website at advantaira.com. And with that, I'll go ahead and end today's webinar.